For nearly 2 decades, Vikas Agarwal built his career in corporate finance and M&A, working with Fortune 500 companies and private equity firms. But in 2012, he dipped his toes into real estate by buying residential properties in Florida, then Minnesota, and one after the other, laying the foundation for a very different path. By 2020, he pivoted fully into commercial real estate, starting with a family dollar in Wisconsin. And today, he's the founder of Arka Capital Holdings, where he's building a portfolio of medical real estate across the Midwest and beyond. Vikas, welcome to the podcast.
Thank you, Leo. Thanks for having me on the show. Appreciate it.
You bet. So, your journey, I was doing some research. It seems like there's a lot of little things that you've done over the years. I mean, you've even worked for Champion Homes, which is in my space, in the mobile home park space. So what would you say were the most pivotal moments in your journey so far?
It's a great question, Leo. And the answer is in your question, actually. The pivotal moment was Champion Homes. Before that, my career was all in corporate finance and strategy. So I was involved in a lot of mergers and acquisitions for my company. But when I joined Champion Homes as a general manager for their plant in Worthington, Minnesota, they were doing a lot of business with North Dakota because of the oil boom. And we couldn't make enough boxes to supply to North Dakota. So I was their general manager for a year, and we almost produced, I think, more than 350 boxes, which converted into more than 200 homes. So that was the pivotal moment to get into real estate. But as you might have noticed, I started with very simple, just buying single family homes and condos and townhomes, and slowly moved to commercial, and then from commercial to medical real estate. So it's been a journey. Yes, still on
Yeah.
journey. Let's see next 20 years what we'll be doing.
Yeah, I think you follow a lot of people's progression, right? I think most people, they start with residential property because it's got the lowest barrier to entry. It's easy to learn. It's hard to mess up for the most part, and it's easy to get into. You don't need a whole ton of money to start doing it. But I think what it teaches you is that it teaches you the benefits of real estate, right? That you're able to rent out a property, provide a good service to the economy in exchange for cash flow. Tenants will pay down your loan or something like that. You'll have the property appreciate. You'll get some depreciation benefits as well. And then a light bulb clicks and you're like, hey, let's do more.
Yeah, but like single family townhomes, they kind of loop you in the real estate. So they give you a little bit money and you work on that, but then you see the real power of investing in real estate. I think in my experience, real estate investment is one of the most popular investment vehicle outside stock and bond, and with relatively low risk. Overall, we know there are cycles, ups and downs. We lose money. A lot of people have lost money, but there is something tangible about it. So that makes it easier for anybody who is looking for a passive income or active income and is willing to work. Single family homes means sometimes a lot of work, but if you work hard, you are going to get the cash flow. So you can lower the risk by working hard.
Yeah.
So that's the real draw. You have control, some level of control over the situation.
Yeah. Yeah. I think you touched on an interesting point that it's a tangible asset. I think a lot of people talk about it, but in practicality, what it means is like, for the companies that you buy, like, yeah, I mean, sure, Apple probably won't go anywhere, but there is a lot of smaller companies that just might, go bankrupt one day. There's like Chegg, right? I mean, Chegg is like this college, study tool or something like that. Their entire business just went almost under in like a few short years. So it's like, okay, at least you have something tangible. Like if you take a single family home, for example, the wood has value, the roof has value, like there is some sort of base level of material there. So that in and of itself is a way to mitigate your risk.
And it's such a essential product that there is no option to it. Whether you own it or rent it, that product is not optional. You need a roof, you need some place to live. And adding to your point, there is a replacement cost to it. So that replacement cost is always going to protect how far below the value of your asset can fall. Even if your property is 20 years old, but the replacement cost is going to be much higher. So there is some level of downward protection. If
Yeah.
you are in real estate for long term, then even further, it's the lower risk.
Yeah. And so based on your progression of real estate, like how did you transition from residential to commercial to now medical office? Was there like an aha moment or did it require a lot of building of skills and systems and things like that?
And it reminds me of Steve Jobs' speech at Stanford convocation. He said many times you can only connect the dots backwards, right? And when
Mm,
I look back, that's how I feel. Investing in single family was a relatively easy idea, but at one time I had 9 single family homes with a full-time job, corporate job, which was 50 to 60 hours per week, the corporate job. And then having 9 tenants in Florida and in Minnesota. And I realized this is not sustainable and definitely not scalable. Forget about scalable, but it's not even sustainable. So that's when I started thinking about commercial real estate. And this is the time of 2019 and 20. And that time, dollar stores were considered one of the safest investment. They probably still are. And that's what kind of my trigger. I cannot continue to manage 9 single home with a full-time job. So I bought a first Family Dollar. Interestingly enough, in 2024, they closed the store. Uh, That was my first commercial real estate investment. And after 4 years, they shut down the store. But again, this is a good story for real estate is they closed down the store, which was a challenge. But within 6 months, Dollar General came up and they said, we want to rent this store. So Family Dollar out, Dollar General in. And they signed another 10 years of lease. So it's a little bit, maybe I got a little bit lucky, but there are always other things you can do. So those who are listening and they're thinking, if I go into commercial and if tenant leaves, what do I do? Of course, you will have to figure it out. But things do happen. There will be ups and downs and something will show up. Maybe you will not make enough. You will make less than your projection, but there are a lot of things that can happen. So from there, then again, it's just the accident of life. Like I ended up working for a healthcare company, Midwest Dental. So they had around 250 dental locations in Midwest. Our company got bought by a bigger company from California called Smiles Brand. And at that time, they had 970 or almost 1,000 locations across the country. And as a VP of finance, like it's my job to a lot of time look at how the different locations are doing 970. And that's where I felt like within commercial real estate, probably medical is going to be one of the most stable because the services these companies provide to patients are gonna be there for long term. Even the internet, telemedicine, they have their limitations. You have to have real estate. We had 970 locations. Secondly, right at we were still coming out of COVID at that time. A lot of medical locations were closed for a couple of months, 3 months, but then they bounced back. They were open again. They were doing all the business. In fact, there was a pent up demand from the patient. So that kind of got me convinced that if you're looking for low risk and asset class, which is going to be there for a long time, then one of the asset classes is medical real estate. So then I started focusing on medical real estate. We have 9 properties and last seven are all medical. We are in fact closing one right now. So our goal is just to keep growing into medical real estate.
hmm. Interesting. So going back to your first Family Dollar, how did you put that deal together? Was it you? Was it a group of people? How did you find that deal and learn about it?
Right. So I used to live in Minneapolis, Minnesota, and this Family Dollar was just 45 minutes drive from Minneapolis into Wisconsin. And the very first deal, I just bought it from my own savings. There were no investors at that time in this deal. And the reason was it wasn't too far, just 45 minutes drive, and in a small town with around 2,500 people, which is the perfect size for dollar stores, right? If you're a large town or large city, then there are going to be multiple options for customers, for consumers. But this town had only one grocery store, and that was Family Dollar. So all 2,500 people that, or they would drive for half an hour to go to some other place. So I think all these things like the necessary nature and all that, not being too far, and this was still a size which is doable. Like my this property was less than $1 million, my very first property. So I didn't want to start with large deals where if I make mistake, it could really ended up hurting me in long term. And maybe I get turned off by real estate. So my formula is always start small, less than $1 million for the entire property, decent returns, not make you rich kind of returns, but still pretty decent returns, and you learn through it. Sometimes I think working with large companies like Family Dollar, Dollar General, there is a little bit of learning experience as well. How do you, because in the past I was dealing with individuals, my tenants, but now I'm dealing with corporates, their lease department, their reimbursement department, and all that. So it was a good experience. Like by plan, it was a low risk investment.
Yeah, I think that that makes sense to scale up your risk and your size. I think contrary to what you hear out there on popular media nowadays, right? People are like, "Oh, think big, like do the biggest thing that you can." But I think that's just it gets attention, but for most people, it actually doesn't make a whole lot of sense because you're taking a lot more risk than you're used to taking and there's a lot more at stake. So the mistakes that you make are magnified as opposed to learning from your smaller deal.
And I think like once you have a family, right? You have kids, you have family, you have mortgages, and still you want to grow. In that case, managing your risk is even more important. So
Hmm.
if you're comfortable with taking a lot of risk, you don't have to. Just choose your own pace on your own.
So how do you think about risk, when you have a family and how do you manage it and also growth at the same time?
That is the, I won't even say $1 million question. I would say that's $1 trillion question. Most of us go through that challenge, like safety versus security and work life balance. And what I think is initially start with some small risks, small deals, and manageable risk, right? So, in the worst case scenario, even if your deal doesn't go as per your expectations as your performer, you make less money. Make sure, even if it is not highly successful, you don't lose money. If it is very safe, you have good tenant like Family Dollar or Dollar General, or some long-term lease with a medical tenant, then you may not make a lot of money out of your investment, but you won't lose money. You're also going to gain experience. So I think initially that strategy may feel like it's slow. I'm not growing fast enough. Somebody else has already $100 million portfolio. I don't. But if you're comfortable, do that. But if not, don't look at others. Just do what makes you feel comfortable. At the same time, I think your spouse is very important in this calculations. Yeah, you have to be on the same page with your spouse. Like, do we maximize our okay, or we invest in real estate or in bonds or all the stocks, tech stocks doing great right now, actually. You do that. But I think the one thing you cannot do is take a lot of risk and put your family's well-being in danger. So slow and steady will get you there.
Yeah, I think that relates to what Warren Buffett said, right? The rules of building wealth. Rule one is don't lose money, and
Mm.
rule two is don't forget rule one, because it sounds. When I first heard that, it sounded kind of like obvious. It's like, well, who wants to lose money? But I think then you think deeper. You're like, okay, well, that's a relationship between risk and return. The type of risk that you take, you want to make sure that your downside is protected, and because for each percentage of downside, you need to work that much harder to go to the upside, right? Because like a 10% drawdown of your portfolio requires 11% to get to where you were previously. A lot of like stock traders, like that's how they blow up their account. And for real estate people, residential real estate, I think that's like easier to manage. But when it comes to commercial, when you have multiple loans, multiple deals going on, then the risk becomes a really, really important measure. And so knowing how to take it the right way, your risk exposure, making sure that your assets are not over leveraged, things like that is super important. And of course, having your spouse on board because I mean they're your life partner. If you don't have your biggest partner on board, then what are you doing?
Like if your partner is not on board, your chances for failure is probably at least twice higher.
Yeah, yeah,
What if they are on board with you? And to add to what you said about Warren Buffett, I think it sounds so obvious. Like you feel like Mr. Buffett is being Captain Obvious, but then you live your life and then after 10, 15 years, you do see the wisdom in those simple words that play safe. Here's another quote, which is one of my favorite is market is generally driven by two emotions, greed and fear. So either people are in fear and they take actions that they shouldn't because they are scared, or they do things because they are driven by greed. So if you can control your fear and greed, that will keep you stable. I know I have a lot of friends who invest in different asset class, including multifamily. There was a time a few years ago, people were expecting 20 plus IRR, percent IRR. Lot of money went into it. Some did okay, many didn't do okay. And that's those kind of things you have to take a pause as an investor and think it through. Is this 24% IRR, 28% IRR? Is this too good to be true? So that's where this fear and greed comes into the picture. Somebody's
yeah.
offering 16% IRR and somebody else is 24. Obviously, you're like, oh, why not 24? But did you do the risk and return analysis?
Yeah, and I think that's where a lot of investors, like newer investors, they're passive investors, so they think that passive just means that they don't do a lot of research into it, which is kind of a mistake in and of itself. But also, any sponsor can make a number look sexy on their pitch deck, right? They could throw out a nice fancy like 24% IRR or something like that and get people in. But what the investor doesn't realize is that, hey, what are your assumptions? Like, what are you assuming is there to make this happen? So maybe it's like the exit cap rate was too aggressive, or their their expense ratio was a little bit too optimistic, right? That things cost more than they say they will, right? I mean, past few years, it's like what? Taxes, insurance, and then interest rate. Those are the three big killers, right? We've seen a lot of people into multifamily apartment buildings. That's like where the wave comes in and eats them. And then, these investors, they lose their money and they're like, what the heck happened? They're like turned off on the asset class. And, I think another thing to add is like it's important to say yes, like it's important to live and learn. It's not that investing passively is not the right thing, but you need to look deeper. You need to figure out like what forces are at play, the assumptions, the sponsor team, and the different, even the location of the asset, for example.
Absolutely. And I think that's why the track record of operator matters, right? Not all the operators who don't have long, like 30 years of experience are risky, but look at their approach, their strategy, and at least some track record because there are so many factors. If we want to do something, I want to invest in 24% IRR, naturally I'm going to avoid some of the red flags because I already made up my mind that 24 is better than 16 and that's what I'm going to do, and I'm just more inclined to ignore all the red flags. But if the operator has a track record and their investment strategy, that's your fallback option. I think one thing about real estate is very few people consistently make money. Everybody lose money now and then. It's always a one deal which horribly goes bad. And that's what matures you as a real estate investor or an operator or, in any way. So having a perfect record, personally, I don't think is super important either. You just don't want to have a operator who consistently lose money. But if somebody lost money one or twice, that in my mind is okay because that's where you gain maturity, you become more refined, seasoned. But at the same time, don't look for an operator who have lost a lot of money in a row.
Right. And it's very interesting you brought that up because there was this family office that I heard of. They specifically don't invest in sponsors that have not lost money.
Well,
And yes, it sounds very counterintuitive, right? But what their mentality is that exactly what you said. They had a couple of deals that gone sour, and they're really listening in on what exactly went wrong, what assumption was too optimistic, or what mistakes that people overlooked, and how did the sponsor deal with it? Because that's very important because like if you're always winning all the time, you learn nothing. You learn that your formula is the best thing since sliced bread, but maybe you didn't take enough risk, maybe you could do better, or maybe you're covering up your losses, maybe you have some sort of you know defense mechanism against like you saying that you know making yourself vulnerable and admitting to your losses. I think there's a lot of people out there that just don't have it in them to be like, hey, look, I messed up. Here's what I did. Here's how I made it right. Here's how I explained it. People weren't happy, but they understood. And that's what we as CEOs of properties, right? I mean, if you think about it, a property is a business and you're the CEO of it as the sponsor. That's how you run it.
personally, I think if somebody is in the real estate for 20, 30 years and if they say they never lost money, very good chances that either they have come from the heavens, so they know the future,
Yeah.
or they're lying, one of the two.
Yeah. Yeah. Or they just have like a crazy long time horizon, right? A lot of family offices, they never sell properties and it's like, okay, well, you'll ride the wave up and down, then fine. But then to that question is what's your opportunity cost of capital? It's like, okay, you never lost money, but could you have made more if you just cut your loss, move on to the next one and made more? But with that being said though, I wanted to just understand your journey into the medical office space. I know you were saying, you sort of got a glimpse of it. You were working at a healthcare company, and then you looked more into the medical office space. So how did you learn about that field? I mean, did you have like mentors? Did you have like resources that you went to, or like how did you like build the systems to even be able to execute on a deal like that?
I think for me, the biggest reason was me myself working for a healthcare company, right? So we had access to almost 1,000 locations, their financial, which one is doing well, which is not doing well, why it's not doing well, the location and all those things, right? So I think that gave me first good idea. How can you tell if this location is gonna be successful or this location could struggle in future? For example, I'm just gonna give a few example about dental locations. You want to see how many new patients they have gained in last 12 months versus how many patients they have lost in last 12 months, right? So when I'm buying a medical property, especially let's say dental location, I have this questionnaire for the tenant. Tell me how many new patients you have gained, how many you have lost. And very obviously you want to see bigger number for gaining than losing, or at least the same. But you don't want to see we gained 100 patients, but we lost 300. Then it's only a matter of 3, 4 years before they would go out of business. So that questionnaire where you can figure out the general health of the location. Who are the doctors? How much time they give to this practice? Because in dentistry, it's very common for doctor to work at multiple locations. So Monday, Wednesday, they work here. Tuesday, Thursday, they work somewhere else. Friday, somewhere else. So you want to make sure that property that you're buying has enough time allocated by the doctors, by the hygienist, and all that. So going back to, I think I got lucky in the sense that I ended up working for a healthcare company. So that gave me inside knowledge of how to check the finances, how to have some sort of idea that whether it's going to do okay in long run or not. But those who don't have that healthcare industry experience, but still you can replicate that. And nowadays it's even easier with AI and ChatGPT. Try to figure out uh, how's the services at that location, what quality of doctors, hygienists, staff, what is the patient rating for that location. Even though in medical industry, medical real estate, generally leases are long term and generally they are triple net. So as an investor, your risk is very limited. You already have a long term lease and all that. But at the same time, even though your risk is lower, still you want to make sure you are not collecting rent from a dark property. So your rent may not be risked because it's guaranteed by, let's say, a corporate guarantee. So they may close the location there. Still, you will get the rent, but still, it's not ideal. You want to buy a location that in 5 years, if you're selling, still there is a tenant, and your buyer is not buying a dark property because the cap rate is just easily can cross to 10% if it is a dark property.
Yeah.
So I think slowly build a system where beyond just the corporate guarantee lease term, beyond that, you can also figure out if patients like this doctor, they like this property, because that is the best gauge of businesses if it is going to survive in long. So that's at the core, but at the same time, you learn with experience. Lot
Yeah.
of times you do everything and still you get surprised. So start with, and nowadays I think with ChatGPT, it's so much easier. Even if
Yeah.
you just ask them like, come up with a questionnaire for me for a dental location to see their health of their business. Literally that easy to have an initial list and then you can go from there.
Makes sense. And the property owner would let you just talk to the tenants like that during diligence, or
You can make it a contingency, right? Sometimes they don't want to do that, but then you can say, I don't need to talk to, if you can just get it filled out by them. Either I will talk to them and anyway, you will get the property tour as well. Uh, so as long as you get the answer, that's your goal. Either
yeah.
you get it directly from the tenant or they get it from.
Right, makes sense. And if the seller gives it, then you want some reps and warranties to make sure that they're telling the truth. Yeah. So what kind of like valuations or like cap rates do you guys see in the medical office space?
Right.
And is there like a big range?
Right. So cap rate is obviously, there are many factors that goes into it. One big factor is the length of the lease, right? There's a lot of sales lease back in medical real estate. So the current owner, landlord is selling their property to you and they are becoming your tenant because let's say there's a dentist who bought that property 20 years ago and now he's close to retirement and he's selling the property. So a lot of time it's a sales lease back. If you have a long-term lease, let's say 10 plus years, and the type of lease, it's triple N or double N or actually triple N or gross. But the kind of property we focus on, Arka Capital, 10 plus years lease, triple net lease, credit worthy tenant, and 2.5-3% of rent escalation. Then we expect, given let's say interest rate is 6% right now, so we would look for at least 150 to 175 basis point of positive spread. So if my interest rate is going to be 6%, I would look for at least 7.5% cap rate. The reason being is very mathematical reason, that if you're going to do 70% LTV, 30% equity, and your spread is positive 150%, then you can get 5, 6, 7% cash on cash for your investors. Um, and then IRR could be easily into 13, 14, 15%. Now, given most of us believe that interest rate will drop. So if you have 6% right now and you expect it to conservatively even drop 100 basis point in next 2-3 years, you can refinance. But if there's a rent escalation, your cap rate is now gone from 7.5 to 8%, but your interest rate is 5%. Now you have a 300 basis point spread. So cash on cash can even get it to double digit. So generally, what kind of cap rate we look for is highly correlated to what kind of interest rate banks are offering you. And then again, of course, the lease type, the quality of the tenant, all those things.
Makes sense. And what would you say are just like in general, like what are the biggest draws and drawbacks to this space in general? I mean, I get it, it's like stable, but then maybe there's like a lot of nuances to the tenant type and things like that. Right?
So I think pros in terms of, as you said, it's very stable. You're dealing with highly professionals, right? Very highly educated professional tenants. If it's a corporate lease, you're dealing with corporate people. So it's very professional, easy to manage. There could be some extra process and procedures, but still it's relatively easy. So those are the long-term lease, all the pros. But there are certain cons as well. For example, the per square feet build cost is much higher in medical real estate compared to some other segments. If I just roughly use an example in multifamily, let's say if per square feet is $200, but in medical real estate, I think sometimes 450, 500 per square feet is not out of bound. Like a lot of time you see 400, 500, even $600 per square feet. So it's by per square feet, it's much expensive. Um, so that's one drawback. Like if you're paying $2 million, you may still get 3, 4,000, 4,000 square feet location. So if in future, for some reason, you have to move this property away from medical to something else, let's say you're moving it from medical to retail, then you're competing with other retail location where the build cost was $200 per square feet versus your, which was 400. So that risk is there. You have a very expensive real estate. And it's okay because medical tenants are paying that. But God forbid if you try to convert a medical real estate into something else. So that's one risk is there. Secondly, sometimes I think uh, for some reason, if you have a vacancy, it could take some time to backfill it. Uh, but once you backfill it, then it's also possible that now you have for a tenant for 15 years. So it may not just get filled in 1 or 2 months. It may take some time, but once it's filled, then you may have for 15 years. So that's both side of the coin there.
Hmm.
And the biggest thing is in medical real estate, you're buying an expensive property per square feet. So that's one risk is there.
Yeah. Makes sense. And so speaking of leasing up, I mean, it seems like it's a similar problem that you're solving for, even like in the family office or the family dollar days. So like, what are a couple of tactics that you use that have been most helpful to lease up these properties that traditionally takes a longer time to find a tenant for?
It goes back to building a good network in the industry. I think if you think about the five forces of the business, one key force is your vendors, your suppliers. In our industry, it's brokers, agents, and those who have good connection with large hospital systems. That really a very, very important value that you have if you have good connections. So far, we only had a few times vacancy, but I lived in Minneapolis and now in Denver, and I'm very active in building network, meeting new people. So I have long, like 5, 10 years of trusted network that I can go to. So that's the key. The more people you know, the good network you have, you can mitigate that risk. Otherwise, if you not, then it can add more and more vacancy to you.
Yeah.
So I think where I'm going with this is no good silver bullet there, but
Yeah.
it's open school, have a good network. And you build that network intentionally that I need some good connection in case I have vacancy. I need some good connection if I'm looking to refinance. I need some good connections if I'm going to do some addition to this property. So
Mhm.
intentionally you build that network that this is my group for that. This.
Yeah.
and it takes time.
Do you have, like, a system that you keep your contacts organized, like people to refi or people to bring up tenants and stuff like that?
Yeah. I started with a very sophisticated system called Excel.
Yeah.
So that was my, as a finance person, like for us, everything is Excel. But now we are moving to, like, I'm on investor just like you. And I'm now in the process of exploring different options to see if we can move all of our contacts, investors, supplier, like to some CRM. So we are still in that process. But so far, it's very much based on Excel. So if you see my Excel, you will see columns after columns, like
Yeah.
gross discussion April, next discussion June, and so I do that recording, but it's not very user.
Yeah, I think I'm in a similar boat. I think I also have some systems that I'm trying to use, and always, like, for example, when it comes to a deal that I'm trying to raise for, it always goes back to Excel. Anyways, like, I just end up exporting all the contacts back to an Excel. I'm like, did I speak with this person? Great. Next.
I think the user, when it comes to user friendly nature, it's very hard to beat Excel. It's not sophisticated, but it's so user friendly. Like you just go in and start entering information.
Yeah, that's true. That's true. Another thing too. So I was speaking with another operator for retail space though. It's different, but then she was running ads on Facebook and YouTube for just attracting tenants. So sometimes there's little interesting ways that you could do it. Maybe it's like running ads in a certain geographic location within like a hospital, right? Like maybe it's like a 1 mile radius. Like put a few dollars to it. Maybe that might even help.
Right. Absolutely. That makes sense. And this is somewhere we are just working on our marketing strategy to build a solid database of accredited investors because they are the prized money, right? Everybody is looking for investors. The good side of medical real estate is it's to come up with an avatar for these kind of properties. The investor avatar is relatively straightforward. You're looking for other medical professionals, caregivers, because they would be technically the most interested in investing in these kind of properties. So the marketing ads could be very focused on them. It's not that they are the only investor, there are other investors as well. But if you're just beginning to build your database of investors, that's where you would start.
Yeah. True. And I did want to change the topics real quick. There was something on my mind that I wanted to ask you. So, I mean, your journey, right? It's been in so many twists and turns, and like you said, like looking back and connecting the dots makes perfect sense. So, while you're going to each new thing that you're doing, were there some sort of mental models that were most helpful for you, like decision frameworks or like ways to stay organized, manage risk, etc., that was helpful to you to be where you are today?
I think as an immigrant, right, you have a little bit different take on the situation. For us, it's the land of opportunities, right?
Hmm.
It's somehow natural when others see problem, we see opportunity. And there is a saying, you didn't come this far to come only this far. You have to keep going. So that's restlessness is always there. And that always keeps pushing you for going to the next step, next extra mile, next extra mile. So sometimes that helps. But at the same time, I think your background, your entrepreneurship, these sometimes these things come natural. Either you have it or you don't have it. But at the same time, if you're driven and you have a long term goal in mind, then I think you just have to start. Don't have to have a very solid plan. There was a very famous saying that a journey from New York to San Francisco still start with the first step, even though it's that long of a journey, but still you have to take the first step and then only you can do it. So I'm a big believer of that. One thing I do believe, if you get a good mentor initially, it could save you so much time, energy, and money because there are certain things you only learn by experience, either your own experience or somebody else's experience. So it's always cheaper and more cost effective to learn it from somebody else's experience. So I think That's something I would recommend. And having a long term goal in your mind with a one or two good mentor be a solid start.
Hmm. Definitely. I think learning that fire is hot without touching it, that's very important. Yeah, and not making the same like mistakes that people commonly make, right? I think if there's a way to shortcut your learning, pay down that ignorance debt, it's well worth it. And I feel the same way. So Vikas, I appreciate all your wisdom so far. I have one last question for you, but before that, can you tell the listeners how they can connect with you, the type of people that you're trying to meet, and how they could stay posted on what you're doing?
Absolutely. There are many ways to connect with me. You see my name, Vikas Agarwal. Feel free to connect with me on LinkedIn. Put Vikas Agarwal and Arka Capital, RKA, and it will take you to my LinkedIn page. Check out my website, Arka Capital Holdings with S, arkacapitalholdings.com. You will see my portfolio, upcoming opportunities, and obviously connect with me. Those are the two fastest way to do that. You can also email me at my first name Vikas at arkacapitalholdings.com. I would love to hear from you guys, chat about the industry, and there's always a learning, right? So hoping to learn from you, and hopefully I can share a few things from my side.
Nice. So final question, Vikas. Looking back in the past 10 years of your life and your career, what would you say was the best decision that you made? And then what was something that you wish you knew 10 years ago?
Right. Uh, I think the best decision was this year in March. Like I started my career in corporate finance, right? And my all-time dream was one day I want to be a CFO of a company, right? And this year, starting of this year, I became CFO of a company in Midwest of a nutrition company. But in March, I quit that job as a CFO to full time do real estate and medical real estate. I think it's very hard sometimes to let go something which is paying your bills, right? Being a CFO, it's kind of a golden handcuff.
Yeah.
So it was a very bold decision, but I think probably one of the best decisions. So that's, and there's also for other, like once you have some level of passive income, and if you feel like that's your future, you have to take that plunge. You have to make that one time big hard decision. Otherwise, you'll always be flipping back and forth between safety of W-2 job versus risk. But my heart is here, but this pays my bill kind of a situation. So that's one. But 10 years ago, I think there are many things I would do differently. But again, I would have looked for more seasoned and solid mentors early in my career because I'm mentoring a couple of people now. And what I'm telling them, most of that I learned it the hard way. So I wish somebody would have told me so I didn't have to learn it the hard way. But now I'm making sure that it's paying it forward. So if you are into real estate or any industry, go find a good mentor and don't feel like you're only asking something from them because there's always a two-way learning. Um, I also learn from my mentees. So do that, have a big goal, and have fun actually,
That's the meaning to life, right?
right?
Have fun along the way.
Have fun. Life
Awesome.
is
Thanks.
not a destination, it's a journey. So
That's right.
enjoy the journey. There's no destination.
The journey is the destination because the destination is you dying. So have fun. All right. Well, thank you so much, Beckus.
Thank you.